Welcome to the deep dive. Today, we are strapping in for a high-speed strategy session. We're going to cut straight past the polished executive intros.
Yeah, skip the formalities.
Exactly. And jump right into the strategic Q&A from Roku's Q3 2025 earnings call.
That's right. Look, for anyone tracking the future of connected TV, I think the single biggest question is, can a market leader like Roku keep up this hyper growth and be profitable as the whole landscape matures?
Right.
So our mission today really is to distill the core strategic answers the company gave. What specific levers are they actually planning to pull? How are they going to monetize that huge scale? We're talking, what, roughly half of U.S. broadband households?
It's massive.
And how does that push them into 2026? That's what we want to figure out.
Okay, let's unpack this then. The overarching theme I picked up was, well, striking confidence. They aren't just talking about revenue growth anymore. It's profitable revenue growth.
Definitely.
And they seem to have three very specific strategic pillars backing that up.
Indeed. The fundamental goal, the CEO really laid it out, is maintaining double-digit platform revenue growth while simultaneously accelerating profit growth. That's the key bit for 2026 and beyond.
So it's a shift.
It really is. It's moving from just grabbing market share, land grab, to executing really efficient, profitable expansion.
Okay, so before we dive into the nitty-gritty on those pillars, let's just quickly touch on the financial foundation, because that looked pretty strong.
Oh, yeah.
They just hit positive operating income for the first time since, fiscal 2021? That alone feels like a major milestone.
It absolutely is. And, they have the capital to back up that confidence too, right? They've got $2.3 billion in cash and short-term investments. And they're trailing 12-month free cash flow, over $440 million. That kind of financial health, well, it immediately translated into action this past quarter.
Yeah, I saw that. The CFO highlighted a $500 million stock repurchase just this quarter.
A big chunk.
And they stated this long-term goal of offsetting 100% of share dilution over time. That's a pretty loud signal to the market about expected cash generation and, future value, isn't it?
Totally. It says, we think our stock is undervalued and we expect to keep making money. And, when the analysts started pressing them on the quality of that revenue growth, the underlying numbers were actually quite encouraging.
How so? What did they say?
Well, if you strip out the revenue from political ads, which, always go up and down, and something they called friendly revenue.
Right. What was that again?
Basically specific kind of non-recurring platform partnership deals. If you take those out, the underlying organic growth rate in Q3 was still a solid 19% year over year.
Okay, 19% organic. That's strong, steady momentum. But what about looking forward? Did analysts ask about the Q4 outlook? What's the trajectory there?
Yeah, they did. And the Q4 guide seems to imply a bit of a step up in that growth rate, maybe closer to 20%, perhaps even 21% organically. Now, this is where, some of the financial jargon kicks in. They mentioned factoring out the impact of 606 revenue adjustments.
Ah, yes, the accounting fun.
Exactly. So for you listening, what that basically means is just a shift in how they have to account for certain marketing incentives from, previous periods.
Noise, basically.
Pretty much. When they strip out that confusing noise, the core business acceleration seems pretty clear. They've got this steady organic momentum carrying them into 2026.
Okay, that clarity helps ground the strategy talk. So let's turn to those three platform revenue pillars you mentioned. They started with improving how they use what they call their most strategic asset.
The home screen.
Right, the home screen. The company calls it iconic. And, I think that's largely because it prioritizes simplicity. It's just one clean entry point, gets you to your content fast, doesn't matter which app it's in.
Yeah, it is pretty straightforward compared to some others.
But they also recognize they need to evolve it, to drive more value from it. And that's where this ongoing update comes in, right? I gather this isn't just a small tweak. It's a major company-wide UI overhaul they're currently testing.
Exactly, a big one.
So what are the goals? Is it just making it look nicer or?
Well, it's kind of a dual goal, perfectly balanced, they'd say. First, increase viewer satisfaction, keep the interface intuitive, simple.
Okay.
But second, and this is crucial for monetization, obviously, is to drive higher engagement.
Meaning
Pushing viewers towards more ad-supported content and also maximizing the opportunities for them to sign up for premium subscriptions right there.
Makes sense.
The CEO said the testing results are apparently extremely positive, and we should expect that major rollout to really shape the user experience throughout 2026.
Okay, so if the home screen is about boosting overall engagement, then the second pillar, subscriptions, sounds like it's about maximizing that premium customer base. What stood out there?
Yeah, premium subscriptions seem to be doing exceptionally well for them.
Yeah.
They're really focusing on launching more Tier 1 subscription services in 2026.
Tier 1, meaning the big names.
The big ones, yeah. Leveraging their distribution power to become, more essential hub for major content owners.
Yeah.
Make Roku the place you manage those subs.
They also talked about their own content, their owned and operated stuff like Howdy. What's the deal with that?
Howdy is an interesting little niche play. It's what, $3 a month, no ads?
Yeah.
They called it an ESOD service.
ESOD.
Extended subscription on demand. Basically, think of it as a targeted, specific bundle of content that they think taps into a large, kind of underserved market. The strategy here, it kind of mirrors how the Roku channel started, right? They believe they can use their massive platform scale to grow Howdy into a potentially very large business over time.
So it shows they're not just aggregating other people's stuff.
Exactly. They're investing in their own content or curated content bundles that specifically drive value back to the Roku platform itself.
Okay, this momentum in both ad-supported viewing and these premium subs, it brings us back to that key metric, average revenue per account, or ARPO. The question came up naturally. Is ARPO growth sustainable? Can they keep making more money per user?
And the CFO gave a very strong, pretty decisive answer on that. He said ARPO is not only sustainable, but it's expected to grow faster than the growth in active accounts.
Faster than user growth.
Yeah, which is a big claim, considering they expect to hit, 100 million streaming households in 2026.
Wow.
Projecting ARPO to grow significantly higher per account than it is right now, that's a huge financial signal.
Yeah.
It means they expect that monetization per user to accelerate faster than their user acquisition. That's the path to profitability.
Right. Okay, now let's talk about the engine behind a lot of that revenue, the advertising technology. That's the lion's share of platform revenue, isn't it?
Absolutely.
Their strategy here seems defined by this phrase, remaining open and interoperable.
Exactly. And being open, in practice, means deepening integrations with all the major demand-side platforms, the DSPs. This is where that highly scrutinized integration with the Amazon DSP comes in.
Yeah, I wanted to ask about that. Does integrating so deeply with a massive competitor like Amazon, doesn't that risk diluting Roku's own long-term edge? Or is the platform revenue boost just worth that risk?
Well, Roku's viewpoint, clearly, is that the platform boost is absolutely worth it. They see this deepening integration similar to the work they did with the Trade Desk before as driving greater efficiency and performance for all advertisers.
So more demand overall.
Right, which ultimately attracts more ad spend onto the Roku platform itself. The Amazon integration is still early days, they said, but they're reporting strong interest already. The goal seems to be becoming an essential infrastructure, not just another walled garden.
Okay, so if that's the infrastructure play with the big DSPs, the real maybe breakthrough stuff seems to be happening in their own performance marketing engine, Ads Manager.
Yes. This is where it gets, I think, absolutely crucial for understanding Roku's future growth path. Ads Manager is their self-service platform.
Right.
It's focused squarely on performance marketing, targeting SMBs, small and medium-sized businesses, and those digital-first advertisers. It's the platform designed to make CTV advertising accessible to everyone, even folks who might have only advertised on, say, Facebook or Google before.
And this is where that really striking statistic came from, wasn't it? The aha moment.
That's the one. In Q3, approximately 90% of advertisers using Ads Manager were new to Roku.
90%.
90%. I mean, that statistic tells you they are not just stealing ad share from TV budgets or other CTV players. They are effectively capturing a brand new pool of advertisers who just weren't spending on connected TV before.
Who are expanding the market.
Totally. They are rapidly tapping into this massive market opportunity, which, by their estimate, is almost as large as their traditional brand advertising business.
That's actually incredible. So what's the key? What's the technology unlocking this scale, allowing these small businesses to suddenly jump onto video advertising, which used to be so complex and expensive?
One big answer: generative AI. They're embedding Gen AI tools directly into the Ads Manager system.
Okay.
So for you, the listener, this means the single biggest barrier for an SMB which is the cost and the complexity of actually producing a high-quality, professional-looking video ad. That barrier is essentially removed.
How does that actually work in practice?
Well, the system allows advertisers to basically just input a few product details, some keywords, and the Gen AI then creates a professional video ad automatically. The CEO said, for free, basically with a single click. It makes creating video ads on Roku as instantaneous and accessible as, like, creating a text ad for social media. That's a fundamental shift in who can actually use CTV advertising effectively.
That really democratizes it. Okay, moving on to content trends. Sports. It feels like sports rights are fragmenting everywhere. Every NFL game seems to be streaming on a different app now. Consumers often see this as a headache.
Right, it can be confusing.
But Roku sees this fragmentation as a tailwind. How does that work?
Well, they view this fragmentation as a major opportunity because it elevates the value of the platform that can actually aggregate and simplify that mess for the viewer.
Ah, the aggregator value.
Exactly. They plan to simplify the landscape with products like their Sports Zone. They want it to act as the ultimate front door for viewers to find their favorite games, no matter which app actually holds the rights. They want Roku to be the best place, the easiest place to watch sports.
Gotcha. Okay, on the other side of the advertising coin, they gave a, I thought, pretty balanced report on the media and entertainment vertical, the M&E space. That's traditionally been a huge spending category for CTV, right?
Oh yeah, historically massive. But the M&E sector as a whole is still very focused on prioritizing profitability over just pure spending growth right now.
So budget tightening.
Pretty much. Which creates a general headwind for, all CTV advertising platforms, not just Roku.
Yeah.
However, they did note the theatrical side of M&E, like movie marketing, is performing well. That's driving investments in their high-impact ad units, like the home screen takeovers.
Right.
But the really important strategic note here was diversification. Because of the growth from SMBs via Ads Manager and growth in other verticals, Roku is now, and I quote, less reliant on any one vertical than we've ever been.
That sounds like a much healthier, more resilient position.
Definitely more resilient.
Okay, that structural strength leads us nicely into the final layer of strategy data and these sort of feature monetization channels. They kept reiterating that their first-party data is their most important asset. It powers everything from ad targeting to AI to personalization.
Absolutely. And this is where a very high-stakes, quite provocative question came up from one of the analysts regarding that really high-value data.
Which was?
What about licensing this data to large language models, LLMs?
Okay, connecting the dots here. Companies like Meta, Google with Gemini, they're spending staggering amounts of money. We're talking tens of billions, right?
Yeah.
Like $72 billion, $85 billion mentioned.
Astronomical sums.
On AI development. And they are aggressively seeking out high-quality first-party data to train those models. It's the fuel they need.
Exactly. And Roku is sitting on this massive proprietary data asset. They know what half of U.S. broadband households are watching, what they search for, maybe even what they purchase through the platform.
Right.
So while they use this data internally today to maximize their own ad performance and sell subscriptions, the CEO did confirm that licensing this valuable asset to external LLMs is, quote, certainly something that we've thought of and are considering.
Okay, thought of and are considering. So what does this really mean then? It means they know they're sitting on a potential gold mine.
They're keenly aware, yeah.
But they're not actively selling it off to the highest bidder today. They're investigating, maybe weighing the pros and cons.
That seems to be the situation. They're maximizing the data's value in their current business model, selling ads, selling subscriptions. But the potential market value of that data purely as an LLM training resource is, well, astronomical.
Yeah.
So the timing of when or even if they choose to tap into that external licensing revenue stream, that's a massive future variable. Could be huge.
Definitely one to watch. Okay, finally, what other emerging monetization channels did they say they were bullish on?
Shoppable TV came up. They're definitely bullish on the long-term potential there, though they were quick to say it's still early days.
Right. It feels like we've been talking about shoppable TV for years.
We have. And they acknowledged it requires a real behavior shift. They literally said they need to teach America how to shop on TV.
Oh, yeah. Okay.
But importantly, they are seeing great performance metrics on the existing shoppable ads they run, and they're actively working with partners to build out that functionality. So bullish but patient.
And tying back to the ad products overall, their long view seems to be this continuous focus on measurability, proving ROI.
Absolutely. They mentioned exploring more performance-based pricing models like cost per action or CPA.
CPA, so advertisers only pay if someone actually does something specific.
Exactly. Pay only when a viewer takes a defined action, like clicking a link, visiting a website, maybe even making a purchase. This increases accountability, right?
Yeah.
And it provides that deeper proof of ROI, which is absolutely essential if you want to keep attracting those performance-driven digital advertisers, the ones coming over from search and social via Ads Manager.
Okay, so let's try to synthesize the biggest nuggets here for you, the listener. The strategic confidence heading into 2026 seems to be built on maybe 3 foundational elements.
I think that's fair. What are your 3?
Okay, 1, the financial foundation is just solid now. Positive operating income, high free cash flow, buying back stock that gives them room to maneuver.
Agreed. Foundation is strong.
2, the massive, maybe even game-changing upside from Ads Manager. That 90% new advertiser rate in Q3 is revolutionary, really. And it's fueled by GenAI just tearing down the old barriers to creating video ads.
Yeah, the Ads Manager story is huge. That's unlocking a whole new market.
And 3, that deliberate monetization-focused 2026 home screen UI revamp. It sounds like it's specifically designed to maximize engagement with both premium subscriptions and ad-supported content.
That's right. It all points to them being structurally positioned, really, to keep succeeding as this sort of open, interoperable partner in what's becoming an increasingly fragmented streaming universe.
But the final provocative thought for you to chew on. Roku is sitting on this incredibly valuable first-party data asset. Big tech LLMs are absolutely starving for this kind of data, given the billions being poured into AI training. They currently say they're only investigating licensing this data externally. So the big question is, as this whole AI and data economy absolutely explodes, will Roku's monetization strategy fundamentally shift in 2026 to unlock this sort of dormant, potentially revolutionary revenue stream?
That really is the billion-dollar question, isn't it, for the next year or so? They absolutely have the asset. The strategic decision boils down to execution and timing. When, or if, does the value of selling that data externally actually outweigh the value of keeping it proprietary just for their own internal ad targeting and platform growth?
What a fascinating dilemma. We'll have to keep watching. Thanks for diving deep with us today.
My pleasure.
We'll catch you next time on The Deep Dive.